Robinhood took a $57 million hit after a glitch allowed its customers to short a surging meme stock. And I was really intrigued by what happened. So then I read this article by Barron's, which I am now locked out of. And then I read this article from MarketWatch, and I wanted more. I think all three articles do a good job of telling you what happened, but they don't explain why and how, and they don't explain any of the implications. So that's exactly what I'm going to do here. I'm going to explain what happened and kind of give my analysis on it. So I think the best place to start is actually their fourth quarter earnings, which happens to also be their full year 2022 earnings. And this is their SEC filing. This is their 10K. No particular reason I'm looking at it here, but I am. So actually, this was a fine quarter from them. It wasn't too bad, actually. So their net revenues increased by 5%, even though their transaction-based revenues decreased by 11%. This, of course, is payment for order flow, or money that Robinhood receives by routing its customers' orders to market makers. So that decrease was offset by an increase in net interest revenue, which increased 30% sequentially or quarter over quarter. So like the top line was not too bad, but here's where it kind of gets interesting. So on the bottom line in Q4, Robinhood lost $166 million, right? So that translates to a loss of 19 cents per share. So $166 million divided by the total number of shares gets them this. This actually is an improvement of 1 cent from the previous quarter. So I guess we'll take it. But it could have been much, much better. In fact, this negative 19 cents is 8 cents worse because of the $57 million hit from the so-called Q4 2022 processing error. And they took a $12 million impairment on this equity investment. So had this not happened, they actually would have had earnings per share of, I don't know, probably, I don't know, maybe like, because I mean this entire 8 cents isn't $57 million, but their earnings per share would have been like, I don't know, 13 or 14 cent loss instead of a 19 cent loss. And in fact, to show you how big of a deal that is, let's see. So let me go all the way up. So Robinhood's, they missed earnings by 4 cents. Analysts were expecting 17 cent loss. So anything above that in absolute value would have been a beat. So had they not had the $57 million whiff, then they would have beat expectations on the bottom line, which is crazy to think about. Top line, they missed by just a little bit, 15 million. So yeah, it's honestly quite a shame. So let me explain exactly what happened. So it's in footnote 4 of their GAAP to non-GAAP reconciliation. So here's what happened. So delays in notifications from third parties and process failures within Robinhood systems and operations in connection with the handling of a 1-for-25 reverse split of COSM allowed customers for a limited amount of time to execute trades and basically sell more shares that they held in their account. Okay, so let me explain kind of what happened here. So, okay, so following I wrote this. So following a reverse split of COSM stock, the number of shares the users had was not adjusted for the split. Okay, so let's just say a user had 100 shares. Because it's a reverse split, they should end up with 4 shares after the split. And the 4 comes from 100 divided by 25, which gets you 4, right? So this stock was selling at, actually, let's just have a general example. Let's just say like a stock was trading at $1 before, if you do a 1-for-25 reverse split, then let's just say you had 25 shares of this stock at $1. Then post split, you should have one share at $25. And the reason is because the price is going to be reflected based on the ratio. In this case, though, Robinhood users who had shares of COSM were able to sell the pre-split number of shares that they had at the post-split price. That's very dangerous. So I'll talk about this in detail later, but COSM was trading at like 32 cents pre-split, and it was $8 post-split. So if a user had 100 shares, which cost them like $3.20, or sorry, $32 pre-split, that means they could have sold 100 shares at $8 post-split. Okay. So they were able to take $32 worth of shares and then sell it for $800 worth of shares. In reality, what should have happened is they should have only been able to sell 4 shares at $8, which is $32. But instead, they were able to sell the pre-split number of shares that they had, which is kind of crazy. So let's keep reading here. So this caused a temporary short position in that ticker, and then Robinhood covered that with corporate cash within the same trading day. The resulting loss of $57 million is recorded within the brokerage and transaction part of the consolidated statement of operations. So what that means is when the person who hypothetically had 100 shares that they could sell at $800, when they sold the 100 shares of 100 pre-split shares, they didn't actually have those shares. They only had 4 shares. So because there was a glitch in Robinhood's system that allowed users to sell shares that they didn't have, that means the customer effectively took a short position because they only had 4 shares, but then they sold 100 shares, so they're now short 96 shares. The interesting thing here is that Robinhood was actually the one who was on the hook. Or I don't know, legally maybe the user was, but in this case, Robinhood said that they covered this out of corporate cash. So Robinhood, the corporation, the company, took care of this. So okay, so what's the big deal, you may ask? Like, if the user sold it for $8, Robinhood would have eventually reversed the trade, and in the interim, maybe they covered the $96. In fact, that's exactly what they did. But the thing is, this stock has a really small market cap, and I think now is a good time to transition to this. Here, let me zoom in one time. Okay. It has a really small market cap. Pre-split, $84 million. It's quite small. So Robinhood's buying actually caused a lot of upward pressure. In fact, this is classically known as a short squeeze, where people who are short the stock try to cover. When people who are short the stock try to cover, then that adds buying pressure, right? And when there's a lot of buying pressure, then the bid, which is the price that buyers are willing to pay, the bid increases, and then that makes the stock price go higher, and then buying begets more buying, and more people who are selling short have to cover their position, and they buy more, and it goes out of control. And I mean, I think a lot of people know what short squeezes are. Like GameStop is the canonical example of a short squeeze now. Like, yeah, I mean, it's definitely a positive reinforcing cycle. So that's crazy. Yeah, this is post split prices. I think GameStop did a 1 for like five, no, 1-for-4, I don't know, 1-for-4 split maybe. But regardless of the ratio that they did, COSM definitely got short squeezed, not not by any individuals per se, but by Robinhood corporate. So this leaves us the question of, how did Robinhood lose $57 million? Because the market cap of this company pre-split was barely 57 million, and the market cap today is not even 57 million. So how did Robinhood lose so much money? So I did some calculations here, but let's go over some of the details first. So the pre-split price was about 32 cents. You won't see it here because, again, there was a stock split, but I chose 32 cents because the reverse split ratio of 1 to 25 makes it so that the theoretical post-split value is $8. I think the math just works out a little cleaner, and it was actually around like 30 to 33 cents. The number, I mean, everything here is just going to be my best guess and my calculations, so it's not perfect anyway. Let's see, can we right align this? Nice. So the post-split number of shares, the pre-split number of shares that they had was about 260 million. And if you divide this by 25, which is the ratio of the reverse split, they had about 10.6 million shares post-split. So now we have to ask ourselves the question, at what price did Robinhood repurchase those shares that customers accidentally shorted? Actually, I don't know if customers accidentally shorted the shares, but in any case, Robinhood needed to buy back those shares. So what price could they have bought that at? So let's just say they bought it back at $8.25, and customers who woke up that morning and saw that they had again 100 shares at $8, they sold it at $8. So that means if Robinhood theoretically bought all of the shares that constituted their loss at $8.25, that means they would have lost 25 cents per share that they covered. Similarly, let's say Robinhood purchased those shares at $10. That means they would have lost $2 per share. Again, it's $2 per share because if Robinhood bought the shares at $10 and the customer sold it at $8, then Robinhood would be on the hook for that $2 loss. And the low is $8.25. That's pretty arbitrary. The high is 23.01. This is mostly arbitrary, but it's also the day's high that day on December 16. So I think the stock price actually did get a little higher, but I guess I could find the day high, but this is good enough for us. So if Robinhood purchased all shares that constituted their $57 million loss at this price, that means they would have lost basically $15 per share. Okay, so I think that is pretty straightforward. So now we know Robinhood's loss was $57 million. So then we can deduce this, which is how many post-split shares Robinhood would have had to buy. Okay, so if Robinhood lost $57 million and he lost this amount per share, then they would have had to purchase 3.8 million shares to have lost this amount. And if we're being very generous and said Robinhood purchased all of their shares at $8.25 and they lost 25 cents per share, that means they would have had to bought 228 million shares. This, of course, is pretty absurd because if we look at that as a percent of the number of shares that were available to the day of the split, that's 86%. So I think that's a little absurd. And this is the total number of shares available, or the total number of shares outstanding. That doesn't even include the shares that are held by insiders or institutions that won't sell. So this isn't even the free floating number of shares. The free floating number of shares is going to be much less. But I mean, as we go down the higher price estimates, then this things here seem more reasonable, like I don't know, 7% of the floats or something. That seems reasonable. Okay, so moving on. So you'll notice that this column is going to be the same as this. So why is the number of shares that Robinhood bought back the same as the number of shares people sold? Well, that goes back to here. Remember, users sold a pre-split number of shares. So for example, 100 shares at the post-split price, which is $8. They should have only been able to sell the post-split number of shares. Okay, so that means users, if they had collectively had like 19 million shares that they bought for, that was worth 32 cents on the day before the split. That means they would have been able to sell 19 million of those shares at $8 after the split. And if these are the number of shares that people sold, then we can also see what was the value of those shares. So, and this is simply the number of shares multiplied by the pre-split price, which I said is 32 cents. So 72 million for the top end, and $1.2 million for the low end. And the spread here is actually pretty high, but the reason for that is because like going from 25-cent loss per share to 75-cent loss per share is 3x. So I think it's a little crowded towards the upper end, but I think like stuff here is very reasonable to think that, I don't know, Robinhood users collectively had between like $1 and $5 million worth of COSM stock that before the split, that they were able to sell post-split for the post-split price. It doesn't seem that crazy to me. In fact, if you do the math and you say, okay, let's just say the Robinhood users who sold at the post-split price all had $1,000 worth of the stock before the split. And 1,000 divided by 0.32 is 3,100. So that means if every user held that many shares, how many users would there have would have needed to have that many shares? And to think like between like 1 and 2,000 Robinhood users all held $1,000 worth of the stock isn't that crazy. And in addition, let's just say like 5 people had $100,000 worth of COSM stock, and then everyone else held 1,000. Then the numbers you get even like less ridiculous. And I don't know, maybe someone does have that many shares. It is kind of a penny stock. I wouldn't necessarily touch it, but I don't know, who knows. It's well, I guess it depends on the time frame, but you could have made money if you bought here and then sold here and then bought here and then sold here, something like that. Anyway, that's not the important part, but yeah, I thought this was really interesting, and I think this is honestly not too absurd. Seeing $57 million being lost on one single operational failure was a little crazy to me. It was kind of jarring, but putting the numbers out here, I think this gets a lot more realistic and makes a little more sense. So that's about it. I think for the rest of this video, I'm going to talk about some of the trivia and other fun facts I learned. So
I also want to mention, and Jason will discuss further in his section, that we had a processing error on a corporate action that led to a $57 million expense. This was really disappointing. We've done a full post-mortem and remediated the issue. It's important for us to build a culture of accountability. So following this event, I made the decision to eliminate the executive team's 2022 cash bonuses. It's my responsibility to make sure that we learn from this, adjust our systems and processes accordingly, and ensure that we do everything we can to prevent errors like this from happening again.
Okay, so and then let's see. In addition, they do talk about this error a couple more times. But first, I should mention, in addition to Vlad, the CEO, canceling the executive team's 2022 cash bonuses, let's see. So the two founders, which are Vlad, of course, and Baju Bat. They let's see, see if I can find. Yeah, here we go. Vlad and Baju announced today that they would cancel their pre-IPO market-based RSUs, which would have awarded $35.5 million of unvested shares. So $35.5 million at today's prices. Wait, that's not Robinhood. So that's easy. So 10 times 35, so that would have been a windfall of almost $350 million. At the peak, let's see, 55. So 350 million, right? Times, was it 55? I don't even know what number this is. So I don't know what number that is. You can tell what number that is, but it's a lot more than what it is today. Actually, I'm dumb. It's just 350 million times 5.5. Okay, but moving forward, they do talk about the year a couple of times. In fact, Vlad kind of asks Jason to talk about it, and Jason says, "I want to provide some context. Each quarter, we process hundreds of corporate actions as part of our day-to-day operations. In December, we received a corporate action that was irregular. It was irregular in both its timing and format. And I guess those two things combined allowed it to get through Robinhood's controls. So a processing error caused us to sell shares short into the market. Eek. And although it was quickly detected, it resulted in a $57 million short squeeze as we bought these shares against a rising market. Telltale sign of a short squeeze. While this event was an outlier, as Vlad said, we're taking it very seriously and have made the necessary changes to do everything we can to ensure that this won't happen again. Okay, let's see. So yeah, I think that's about it. So let's see, what else do I have to share? So I know they mentioned $12 million impairment on Ziglu, right? Yeah, this guy. So I was like, actually, where is that? Oh yeah, here it is. So wondering what in the world is Ziglu, and it looks like a crypto trading app, and it seems like UK based. So I guess Robinhood Crypto has a good presence in the US, but they want to expand internationally, so I guess they got Zigu for that. I don't exactly know what this is, but a little bit more research led me to find that Robinhood was going to buy this for $170 million. And Robinhood is like a $9 billion company. So that would have been, let's see, what is 170? What is 170 divided by, I was like 9 billion, right? That would have been, okay, it's like 2% of its market cap. So not crazy big. But actually Robinhood actually ended up, I guess, renegotiating and only paying $73 million for these shares. So, but anyway, I think all in all, Robinhood's quarter was not terrible. Actually, let's look at their, let's look here. It's the tables. Actually, no, I like this table more. Yeah, let's look at their financial statements because that might be interesting. So let's look at the income statement first. So again, we were talking about how net interest revenue skyrocketed, and that's because they're offering like 4% on like uninvested cash if you pay for Robinhood Gold, which is only $5 a month. So that definitely went up a lot. And their transaction-based revenues, which is again payment for order flow that they get from sending orders to market makers, that decreased by 30%. But I guess all of these offsets and total revenues was up by 5%. And interesting thing, if we look here, 167 plus 27 is 194, and that's more than this. And if I'm not, if and I'm pretty sure this is the first time that Robinhood has had a quarter where this transaction-based revenue was actually less than other sources of revenue. So Robinhood's like mix of revenues is changing, for better or for worse. I'm not an analyst, so I don't know, but it is interesting that it's changing. In terms of expenses, remember the Q4 processing error was booked under here, brokerage and transaction. So had it not been for the $67 million charge, they would have, let's see, 85 minus 67, 18 million. It would have only been 18 million, and that would have been down from 29 million. So let's see, 18 divided by 29. What happened? So 18 divided by 29. Okay, minus 1 times 100. Anyway, I mean, it would have decreased by quite a bit. Let's see, technology and transaction. Yeah, it looks like they're managing costs really well. So it's in terms of operations, marketing, G&A. Yeah, I mean, it looks like they really cut expenses to the bone. Oh, actually, you know what? I think. Let's see. Remember Vlad saying they ended 2020 with a third less people. So if they had a third less people, then I guess the baseline roughly is like, if you have to pay a third less salaries, then the employees whose salaries are booked under operating expenses, everything here which should be down like 33% or so, maybe in aggregate. So had they held the same number, so had they kept the same number of employees, marketing spend actually would have been up a little bit. Technology and development would have been down, would have been flat basically. Everything else. So like this cost cutting is mostly at the expense of employee headcount. Let's see, nothing too crazy here. It's funny, they see like net income and then in parentheses loss here, because this is definitely a loss and this is negative earnings per share. But when they announced net loss here, when they lost earnings per share here, they said earnings. It should be loss per share. Okay, let's see, this might be interesting as well. See, so this is a expenses as a percent of net revenue. Okay, so anything above 100% shows that their revenues don't cover their current expenses, and that's actually a little scary to think about. It really is, but I mean, we knew they lost money this quarter, so it shouldn't be that surprising. Let's see, it looks like general administrative is honestly like one of the biggest categories for them. I mean, it got up to even 91% a year ago. Of course, the macro environment was way different, but yeah, look at that. Let's see, statement of cash flows. Okay, that's a lot of things here. I don't know how to read this. Let's see. Okay, here's where they talked about what happened. Let's look at their balance sheets. I am a Robinhood customer, and I would like to see if my assets are secured. I mean, they should be FDIC insured, and my investments should be segregated, but you never know after events like FTX, especially. See, so current assets actually, let's see here. Okay, so cash and cash equivalents actually increased year over year. Interesting. Cash segregated, so this is customers' funds, decreased from 4 billion to 3 billion. Let's see. Receivables from users. Interesting. Receivables. 6 billion, 3.2 billion. I, w- I wonder what this is exactly. I know on Robinhood you can get like instant deposits. I wonder if that's what is considered as receivables. Huh. Let's see. I know Robinhood launched its borrow program recently, where you can lend out securities and kind of get income. Uh, and that's funny that it's brought up because when that happens, someone else, like an institution or another investor, not with Robinhood, is shorting your shares in effect because they're borrowing it from you. And when they're done borrowing it from you, they'll cover and return the shares to you. Of course, your account looks like you have the shares the entire time. You'd never know. It's just passive income. So okay, I wonder if that's what that is. Securities bar? No, I think this is okay. This is Robinhood, um, like just borrowing securities. Almost half a billion. That's interesting. See, user held fractional shares. These are assets. Interesting. Wait, so that's almost like if I buy a fractional share of like of Berkshire, for example, I buy half that share. Does that mean Robinhood holds the other half? Wait, that's so interesting. Um, I mean, it's gone down a little bit. Maybe that's because the value of the fractional shares that Robinhood had in like reserve has gone down. I wonder if they hedge that at all. But if it's only up to like 0.9999 shares um, that they're like holding in reserve for users to get fractional shares from, I don't know how you reach a billion. Is there if you took the price of all the stocks in the S&P 500, I don't know if you would even reach a million. Actually, we can do some quick maths. I don't know. Let's just say the average stock price is like $300. That's even high. And there are 500 in the S&P 500. That gets you 150,000. But I mean, of course, on Robinhood you can buy Nasdaq listed stocks. You can even buy some like OTC ADRs. So I don't know. 1 billion seems like a lot. Is this a billion? Yeah, I'm pretty sure this is in thousands. No, millions. Let's see. So total assets, it's actually went up. That's interesting. Okay, let's look at liabilities and equities. So accounts payable. Okay, decreased a little bit. Okay, payables to users also decreased. Let's see, user cryptocurrency safeguarding obligation. I have no idea what this is. Oh, no idea. It's crazy. And actually, it's here. Assets related to user cryptocurrency safeguarding obligation. Wait, these net out? I have no idea how the accounting on this works. Let's see. Crazy. Supplemental disclosures. Yeah, there's that number again. Well, the accounting here must be some trickery. Not saying it's fraud. I'm just saying there's a little bit of weird stuff going on. Let's see, in terms of equity, okay, I'm curious to see how shares have let's see how the number of shares has changed. Wow, what a bunch of stuff here. See, additional paid-in capital. So okay, so that's gone up a little bit. I don't believe that's the number of shares though. That's the amount that they have in their corporate treasury, or I guess additional paid-in capital should be the amount that like people who bought the equity have paid the company for that equity. So see, this is 11 billion, right? Wait, so wait, the market cap is not even. That means they should have a deficit, right? Yeah, they do have a deficit, but that's not because of this. That's because they have more liabilities than equity, liabilities than assets. But oh yeah, I was gonna look at the number of shares. Let's see. So basic number of shares, it's gone up by what's that, 40 million, and diluted. Oh, it's the same. These are the same. That's easy. Actually, you know what? 40 million more shares over the course of 1 year for a company like this, that's, well, I would say growing fast, but they really aren't. Their top line was up by 5%. It's not too bad, actually. Let's see, their net loss has gotten a lot better. Um, like the difference here is sizable. It looks like they still have some things to make up for, but not too bad. Um, but yeah, I think I'll leave it here. This was actually really interesting to dig into,